Commissioner, Mr Welsh is back. I'll hand over.
Yes, Ms.
Commissioner, Mr Welsh has already been sworn.
Yes.
Mr Welsh, have you received a summons to attend the Commission hearing today?
Yes.
Do you have the original summons with you?
Yes.
Into that, Commissioner.
Thank you.
The summons to Mr Welsh will be Exhibit 3.21.
Mr Welsh, do you have a statement with you in relation to rubric 311?
Yes.
Is that the statement in front of you there?
Yes.
Thank you. Do you have any corrections to make to the statement?
No.
Mr Welsh, is your statement true and correct?
Yes.
Attend to that also, Commissioner.
Exhibit 3.22, the witness statement of Mr Welsh concerning rubric 3-11.
Thank you, Commissioner.
Yes, Mr Hyde.
Thank you, Commissioner. Mr Welsh, I just wanted to begin by asking you some general questions about Westpac's business banking, and to work through a few aspects of that to understand changes in the small business market over the last few years. So can we start by bringing up your statement? And if we go to page 10 of the statement, I'm sorry, my version doesn't have a doc ID on the top, but presumably it's .0010. Thank you. There's a table, Mr Welsh, that you've set out as part of your statement dealing with the number and quantum of business loans submitted to and approved by Westpac's business bank division in the period from 2012 through until 2017. You see that there?
Yes.
And I want to first just break down what is meant by the business bank division. You've explained in your statement that the business bank division provides banking services to what you've termed micro SME, SME and commercial banking customers.
Yes.
And micro SME customers are customers who are sole traders or businesses with less than 4 employees who have lending requirements of up to $250,000.
Yes.
And SME customers are businesses with a turnover of less than $5 million and lending requirements of up to $3 million.
Yes.
And you were, as I understand it, for a period of time, the general manager in relation to business banking. Is that right? You're not now, but you were back in 2006 to 2008.
Yes.
And just so I can understand, does the business bank is lending to micro SMEs? That's right?
Yes.
It's lending to SMEs?
Yes.
And are there also commercial business customers that the business bank lends to?
Yes, they do.
And when we look at the figures that are set out here, these are the figures not only for micro SME and SME loans, but also for commercial business customers?
That is correct.
Okay. And what we can see is that between 2012 and 2017, there's been some growth, about 10% growth in the number of facilities submitted for approval by the business bank division.
Yes.
And some growth more than 10% in the number of facilities actually approved.
Yes.
And growth, relatively significant growth, more than 10% in the total limit approved.
Yes.
And growth perhaps of about 30 or 40% of the average size of facility approved.
Yes.
And then you've also got a table in paragraph 29 that goes through changes in the number and quantum facilities submitted and approved for franchise businesses.
Yes.
And that, I assume, just means the franchisee business. It's not a franchisor business.
Yes.
And we see again some growth in the number of facilities submitted, some growth in the number of facilities approved, relatively significant growth in the total limit approved, and relatively significant growth in the average size of this facility approved.
Yes.
And what I want to understand just at the beginning is your view as to changes in the market for lending to small businesses, and I think you've used the term micro SME and SME customers, given that they would have up to $3 million of facilities. I might just refer to those as small business customers, if that's acceptable to you.
Yes.
And this information, I'm not sure that we can necessarily draw conclusions about what's happened just in relation to small business lending for Westpac, because it includes commercial lending for hire facilities. And I'm just interested in your view about that.
So broadly in the market, we've seen since 2012 improving growth in SME, in the SME segment that you refer to. So that's more small businesses backing themselves to invest. So we have seen that, and that's been a pretty consistent trend where in the growth.
So for Westpac, you've seen growth in the number of loans being applied for that SME market?
Yes.
And obviously growth in the number of loans being approved?
Yes.
And in terms of your position in the market, do you have a view as to how Westpac's position in the market has changed over the course of the last 5 years in relation to SME lending?
Our market share growth has been nominal. It oscillates a bit, but nothing extraordinary there. Just in line with market would be the best way of putting it.
Have you seen increased competition from lenders for effectively giving dollars to small businesses?
Yes, that's correct. A number of lenders have focused on the SME market to help small businesses, and we have seen more competition there as our competitors support Australian businesses.
And is that, when you're talking about the competitors there, if we can just segment them up, does that include increased competition from the other three majors?
The three majors and also some of the other banks.
Yeah, so, and I just want to break it up because it seems like there's a few different categories of competitors that you would face in relation to lending to the SME market. One are the other three major banks. One is the non-major banks. One is non-bank lenders. And so I just want to work through each of those categories. Have you noticed any change in the appetite for small business lending of the other three majors over the last 5 years?
I think they've all got a clear strategy to try and support this market and improve in it and back businesses. So you can read the annual reports and they show that, and my read of some of their investor presentations show they're focused on the SME market. So yes, if the question is around competition, yes. The competition has increased there.
And in relation to the non-major banks, have you noticed any change in the appetite of the non-majors for lending to small and medium enterprises?
It tends to be more focused on their particular state or area. Some of the non-majors, as you call them, are based in Queensland, for instance, and they're pretty hot competition there because that's where most of their branches and their bankers are. So you tend to find in areas they're particularly strong, or they may focus on a particular segment. But other than that, I wouldn't call out anything exceptional.
And what about non-bank lenders to SMEs? Have you noticed any change from competition from non-bank lenders over the last 5 years?
Probably more laterally rather than as broad as the last 5 years. There's emerging fintech where there's financial technology where they're looking more at supporting small business. So there's a lot more of them popping up. Yes.
Right. And that's what more like in the last couple of years rather than in the last 5 years.
More so than 5 years.
And are there different observable approaches to different segments, so I'll explain that a little bit more. If we take just property development, for example, is there a difference in what you can see in competition for lending to property developers as distinct from the broader SME market?
There's always distinctions in each bank based on their risk appetite, based on what their start position is, based on their view of the market. So, yes, you do. You can see differences in the market, yes.
And in relation to property development then, and I just want to get an understanding of this, because as you put this into some context, now 10 years ago, as we sort of came into and out of the GFC, there were obviously a number of issues that arose for property developers and a change in the risk appetites of banks in relation to property developers. And what I'm trying to get some sense of to assist the Commissioner is where are things at now in relation to that sort of market? And it may be, and I should say, that when it comes to property development, calling it SME, if we limit SME to facilities up to $3 million, is inaccurate anyway.
Typically, with the price of Australian property today, it's a little outside the 3 million for the property developers. So property developers more in the commercial business, and that's a pretty closely watched market, both by a number of regulators and also by banks, because it's something that we're very sensible about how we approach that market. And it does evolve. You watch it very carefully though, and you're very thoughtful about the market, the amount of developments happening. You also look at things like concentration risk for builders. So and banks have different appetite at different point in times, because it depends where their book is positioned and how they view the market. But you do a fair bit of research for the broader market on that.
Right. And when you say it's closely watched, is that synonymous with being cautious and very careful, or does it mean something slightly different?
I think we're cautious and careful for all of our loans on that. But
Sure.
but to be clearer on the property, you break it down into a number of ANZAC codes, and we look at that quite closely. So there's a number of committees that you might focus on property. Well, there's one particular committee for us that focuses on property that looks at it, and we look at our book, because the way we think about property and the way you typically think about a portfolio is you look at the institutional exposure. Westpac has a very strong institutional bank, so we'd look at that. We've also got our St George group that is particularly strong at property, so you look at that and you look at your overall shape of the book and how that's performing and the future.
And just again to help the Commissioner with that, when you talk about the shape of the overall book, you mean one of the things you're calling out is you want to look at how much of your book is allocated to property development, how much is allocated to hospitality, how much is allocated to retail, that type of thing. Is that?
You tend to look at property development, investment, residential development. They're some of the headings that you look at.
And to make sure that your book is not overweight in lending to those into one particular area. Is that
one of the reasons? Yes.
Yeah, and what are the other reasons that would be relevant?
Well, you want to look at how your book might be performing in terms of geographies. So you might want to look at Melbourne market, Sydney market. All the markets are slightly different and have different trends at different times. So you look at you might look at a market. You might even break it down and look at in a city Melbourne and to outer, for instance. So it depends on the degree of analysis you want to do, and you know, a property book is a bigger book for the Westpac group. So by definition, when you have bigger books, you typically would put more analysis around a bigger exposure.
And again, just to bear down on a little bit of that, are you talking about even just the level of scrutiny within that property book of where is it located? How much of our lending to property is in Melbourne? How much of our lending to property is in Perth? How much of it is in Brisbane? Is that the type of thing you're calling out there?
On the property's somewhat unique in that it's quite a large book. So the way Westpac structures in the commercial business is that we have specialised property bankers, and there are a number of them, and there's teams. They're under one leadership team. So often the complexity in banking is to get the data is often quite more challenging than what we would want. So by doing that, you can therefore have a bit stronger view on the market, and then you have to provide an overlay where a leader is accountable for that team, and they would typically look at a business plan of what they want to do in the year, which looks forward but also looks back and looks how much of their book is running off, how much of their book is on investment, and how much book is on commercial property. And
tell me if these questions are going beyond what is within the specifics of your experience, please. But if the last thing that I'm interested in is in managing the shape, presumably one of the things that you're keeping an eye out for is, are we overexposed to lending in one particular area? And that might be a particular industry, it might be to a particular physical or geographical area. There's different ways that you might be overexposed. But if that's identified as a problem or a potential problem, how is that managed?
Hypothetically, you're looking at the market and trying to look forward and predict what's going to happen. So that's probably the first thing. Then you're looking at your current book and trying to understand the dynamics of how that would typically work over the next period. And then the main control point, to come back for the clarity of your question, is that you would then typically look at an appetite for there where you might say, for instance, in a particular state, you were wanting to limit the amount of growth there. And there's a number of ways of doing that.
And for example, you might impose a cap on the amount of new lending in a particular area. Is that one way?
That's a blunt way. We'd like to think we're a little bit more sophisticated than that.
No, that's fine. Please expand.
Well, your preference, you always back your longer standing customers. So you back the ones that have been with you for a long time. They're your first, your primary one. Then there's a range of that follows from that. You tend to want to be backing if you're a bit worried about a sector, you tend to want to back a bit more of the experienced players that are there, and you may well tilt your business a bit if you've got a bit more in a city apartment, for instance. You may look to some outer region apartments.
And that I think involves the idea that you could be out there sort of looking for these opportunities, and I'm just trying to understand whether that's what you mean or whether it's something different. The bank could be out there rather than the customer coming to the bank and saying to the customer, I've got this particular property development, that instead the bank would be out there looking for customers who might be trying to do that sort of thing. But I wonder if I've misunderstood the point.
No, it's a combination of both. It will be obviously the bank looking for new business. It will be clients that you have already. It will be referrals from other clients or partners such as solicitors or accountants that know your market, and also introducers in the broker market.
And that, I think, sounds like what you might try to do is to steer away from using the blunt instrument of putting in a cap. You try to incentivise bringing in lending in the areas you're trying to build up. Is that a fair summary of it?
You try and put your energies focused on the markets that you're targeting and the types of deals that you're targeting. So you can, once you've got the deal on, you want to back your client through the cycle. So you tend to focus more on what we would call the front book, the new business. And then you're sort of looking at the shape of the new business and making calls on that. And sometimes they're tough calls because your banker might be saying, this is a great market, and you'll look at some other data and data points where you'd say, well, I think we might want to slow our origination in that market for new business.
Right.
So it's as much, there's a bit of an art and a science on it. It's not as blunt, it's not as clear as just looking at some numbers and standing back and making a call. You want to use judgment.
Yes, and judgment over a period of time. That is, it's not something you can judge at any particular point in time. You have to be constantly thinking about this and strategizing over the medium to long term.
You'd like to think so, yes.
I want to then turn to some issues about franchises, and we're going to move into the particular case study that you're dealing with. You gave some evidence either on Monday or Tuesday. The days are starting to blur together, I suspect, for both of us, Mr. Welsh. But you gave some evidence about the accredited franchise program and how that works. I don't want to return to that other than to note that if there's an accredited franchisor from Westpac, then you obtain past financial performance information about the accredited franchisor.
Yes, that's correct.
And you want to have that information in order to decide whether or not they should be an accredited franchisor to begin with.
The financial information is one part of it, yes.
Yes. And so what are the other types of parts to it that you'd be concerned about?
Not so much concerned, if I just go a little higher more broadly, is why a franchise system might come about as the normal life cycle of a franchise system is they start out with someone starting out typically a business that's in one particular area, and then they're looking to expand and to grow that. So we would look at their plans, and part of that is you'd look at who their management are and what their capability are, what their experience is. You would look at what their strategy is. You'd look at what their point of difference is, if they've got any unique proposition. You'd look at how they're going to bring on franchisees and the training that they would give them, for instance. You'd look at their aspirations, their growth aspiration, and you'd look at how they would be funding themselves in the future, because any business that's going through growth needs to fund themselves, and they're usually starting to grow at a quicker rate. So you have to look through the numbers quite carefully.
And I think the evidence that you gave earlier was, as a result of that accreditation process, Westpac gains a better insight into the financial state of the franchise. Is that fair?
Yeah, yes, you do.
And that insight into the financial state of the accredited franchise systems is kept up to date by annual reviews that Westpac undertakes?
It is now.
And could we just clarify that qualification? When you say it is now, why do you say that?
I say that because in sort of 2010-12, we tended to it was once every 3 years that you had to review for a longer form, and we might do shorter form reviews. We've brought that into more regular annual reviews now.
Right. And we're going to come, as you know, to Highface, which had been accredited as a franchise with Westpac back in perhaps 2011. I think there's some ambiguity about it, but something like that.
Yes.
And as at 2011, 2012, did Westpac's policy require annual reviews?
No, it didn't.
I see. It only required reviews every 3 years, as you understood it.
Long form reviews, yes.
All right, and sorry, is there a distinction then between a short form review and a long form?
Yes, there is.
Okay. And could you just explain that distinction?
The long form review would typically be the review that you would do for an origination of a new franchise system. So you'd want to have much more, you want to have your full approach at looking at it. The short form review tends to be focusing on a particular issue if some circumstances had changed. So if they'd changed their strategy to grow quicker or enter into a different market, so it might be a review on that basis.
I see. And by by initially obtaining the financial information from the franchise, Westpac then seeks to develop the sector to value ratio.
Yes, that's correct.
And you've told, as I understood the evidence that you've given, and I think this was dealt with a few times, your evidence is the sector to value ratio is a percentage which is used to calculate the maximum amount that Westpac will lend to the franchise in an accredited franchise system against only cash flow. Is that?
If it's the cash, if you're lending against the cash as a going concern with no other security other than guarantees from the directors, which is a normal course. From the shareholders.
We might just turn up the policy, because I just want to make sure I haven't misunderstood the point that you're making. When you say without guarantees, let's take a hypothetical. Let's say that the SVR for a particular franchise is 60%.
Yes.
And if the SVR for a particular franchise is 60%, does that mean that Westpac, under its policy, could lend up to 60% of the turnkey price of the business just against the cash flow of the business?
The debt sizing, as we term it, that you'd lend 60% to that. You'd then want to make sure that the interest cost cover and debt service cover ratios worked as well, because you want to then, so one's the amount of debt, the other is the cash flow.
All right, can we bring up WBC.410.001.2092? And
Which tab is that, please?
that should be tab 25.
25. Thank you.
If we just pop out the paragraph that begins lending under this policy, it's the second paragraph under target market.
Mm-hmm.
And I think
That's easy.
I think the way in which I defined it was the ratio of the loan amount to the turnkey purchase price of the business, but let's assume turnkey purchase price of the business is synonymous with turnkey value of the business. Is my understanding correct, or are you saying something slightly
Oh, your understanding is
different
correct.
Yeah, so if, for example, the business was going to cost, or the turnkey value of the business was $300,000 and the SVR ratio was 60%, then Westpac would be prepared to lend up to $180,000 just against cash flow.
Correct.
Or that would be,
Subject to the cash flow.
sorry?
Subject to the checking the cash flow. This is
Subject
further
to-
in the policy.
That's right.
Yes.
And then I think you referred to the next point, which is any borrowing in excess of the SVR is to be supported by other tangible security in terms of acceptable security rules.
Yes.
And that would mean, would it, that if you wanted to lend, or if the borrower wanted to borrow 100% of the purchase price for the business, they could borrow 60% unsecured, other than assuming relevant criteria was satisfied against the turnkey value of the business, against the cash flow. Sorry, I've put that badly. I'll say
No,
it
no.
again.
Please.
They could borrow 60% of the turnkey value of the business secured only against the cash flow, but the balance of 40% they would need to secure against, for example, residential property, something else.
No, that's not correct.
Okay, and could you just explain what is the thing that I've misunderstood there about that paragraph?
So there's you either fall into the sector, the franchising policy, and if you don't, then it's the business credit manual that would apply. So you don't get I thought I heard you say you can borrow 60% under the franchising policy and then another 40% under the if you wanted to borrow the whole lot under the the business credit manual. So if you don't qualify for if you are above the 60%, then the franchising policy is off the table.
I see. And if you are borrowing an amount above the sector value ratio, then the accredited franchise policy can't apply to you.
Thank you. Far better put.
Is that right?
Yes, it is right.
And because read literally, that paragraph we're looking at appears to say that you can lend against the cash flow for the sector value ratio, and any borrowing in excess of the sector value ratio is to be supported by other tangible security.
No, that's not how it should be read.
That's not how it, well, at least
that's not the
how it's-
practice, and
That's not
that's
how
not
it's
how it-
applied.
Yep.
All right. And what is the reason for that?
Because the policy is a going concern policy, and as a going concern policy, you want slightly higher interest cost cover, and there's more risk around that. So if you take on more debt, then there's without potentially looking at other cash flows and other security, then the risk profile changes. So it's a risk-based decision.
I see. The point is you've taken on debt greater than whatever is the sector value ratio, and simply having a real tangible security for that extra amount of debt above the sector value ratio doesn't mean that you've eliminated the extra risk involved in that extra debt. That's the point.
Yes.
And hence the reason why the willingness that Westpac has to lend in relation to accredited franchisees of accredited franchise systems against cash flow really is just limited to the sector value ratio, because it's satisfied itself that cash flow up to based on is sufficient to service debt up to the sector value ratio.
Well, you apply your financial covenants then.
Right. And so that's the reason why when we get to this particular case study, the borrowing that we've already heard about, it was done not under the accredited franchise policy, but under the general business, because
Yes.
it was for greater than whatever the relevant SVR was for a pie-face franchise.
Yes.
All right. And I think you explained in your statement that the borrowing didn't comply with the accredited franchise policy for pie-face. That I take it refers solely to borrowing more than the SVR.
Yes, correct.
Okay.
Can I just correct one thing I think I heard you say, because while we're here, I wouldn't want to... there still is security for a going concern. You can see that on the second page of that, there, at the bottom of the second page. Because I thought you said, I might have misheard you, but I thought you implied that it might have been unsecured. There's still a fixed and floating charge of the language at that time. First mortgage, there's appropriate guarantee from directors and franchisees, and other tangible security as may be necessary. So it's not a... I wouldn't want the Commission to assume it's a completely unsecured loan once that that tricks in. It's still secured. There is some security there.
Yes, it's secured. It's secured against the business. So that is, you've got a fixed and floating charge over the property. If there's been a purchase of property for the purposes of the business, you'll have a mortgage over that property. You'll also take a guarantee from the directors.
Yes.
It's not, your point is, this is not unsecured borrowing.
Thank you.
Yes, I understand. And so then in practical terms, how, if we come to this case study, in relation to the borrower Marjo, would there have been any difference in approach that you would expect in relation to assessment if this was done under the accredited franchise policy rather than under the general business lending policy?
Well, they'd have to comply with the franchising policy that we just went over.
Well, in relation to, the interest cover and things.
SVR, it's a higher interest cover. Yes, so that would apply.
All right. Can we bring up Exhibit 30? So this is the franchise system profile for the Pieface franchise as at July 2011.
Yes, that's correct.
And as we understand it, this wasn't updated, and this was the policy, that the profile that would have been in place as at the time that Marjo made its borrowing.
Yes.
All right. And then if we go to page .0333. So this sets out some benchmark trading results for franchisees in the Pieface franchise system.
At July 11,
Yes.
2011, yes.
Is there, when you say that, is there some update that you've seen to those figures that would have applied as at?
No, there's not.
Okay. And if a borrower came and wanted to borrow only up to the relevant sector value ratio to buy a Pieface franchise, would these franchise trading results and projections be something that would be relevant to assessing the borrowing?
Yes.
And how would they be relevant?
Well, they're the guide for, as we've called here, low, average and high benchmarks, and that's determined more by the sales at the top, and they'd be the benchmarks you'd be looking for from the business. Gives the banker a guide.
All right. And can we put that then on? Well, actually, I'm sorry. Just before we move off that, can we go to page .0346? So this is the recommendation that was made by the New South Wales Franchise and Development Manager and appears to then be accepted and approved. And you can see that if you turn ultimately over to page .0348. Oh, I'm sorry, it gets, yes, .034.
Yes, it does.
I think we should just check one thing, which is you see that recommendation in the box is a 60% SVR.
Agreed.
And for existing stores, it's a 1.75 multiplier applied to EBITDA capped at 60%.
Yes.
And I just want to clarify, as I understand it, that is what is accepted and approved. Is that right? Or
No, as you can see on 0348, or we can see, I think it's
it changes
redacted here, it changes to a lower ratio.
All right, to 50% SVR and 1.75 times EBITDA capped at 50%. Is that right?
Yes.
Oh, sorry, are you concerned that this is...
No, I just have it redacted on mine, but
Oh,
that's
no,
good.
but it's... Well, the version we have doesn't seem to have been...
Okay, that's good. Sorry, that's why that was a concern.
No, I appreciate the worry. I get lots of blue highlighting. It concerns me too, Mr. Welsh, I can assure you. It's much more
I'm
concerning...
just getting
when-
used to it, though.
Yes, it's much more concerning when just black pages pop up on the screen. That's because I'm fearful of somebody else. Now...
Understand.
So I want to just make sure I've understood the detail of this then, which is that if Marjo had come along and said, we want to buy this existing Pie Face franchise to go under this approved and accredited policy, they could have borrowed up to 50% of the purchase price. Is that right? That is the purchase price taken to be equivalent to the turnkey value of the business?
Yes.
But a further limit would be that they could only borrow 1.75 times the EBITDA for the established business,
Yes.
and that would additionally be capped at 50% of the purchase price of the business.
For the existing stores, yes.
And that reflects, I take it, the level of risk that Westpac would be comfortable with in relation to a Pie Face franchise under this policy.
Yes.
And the relevant parts of the policy, as you point out, are it's lending against cash flow, but it still requires security over
Yes.
the entirety of the business. And it also requires, as you pointed out, guarantees to be given by the directors of the business.
Yes.
And presumably then, assuming that these sorts of franchises are being bought by an individual or a couple or a small group that are looking to run a small business, the giving of the guarantee by the directors will effectively then mean it's being secured by their personal assets.
It could, yes.
And in giving a guarantee, would it also be necessary for a mortgage to be obtained from the director to secure the guarantee?
Not necessarily if they complied with this
I see.
policy.
But in any event, no, that's right, I withdraw that. So that would be one potential difference, which is they don't need to have a mortgage to secure the guarantee, but they'd still have to
It'd
give
be
the
an
guarantee.
unsupported guarantee.
But they'd still have to give the guarantee.
That's the normal practice, yes.
And this is really a risk balancing exercise for Westpac. It gathers a lot of financial data. It makes an assessment as to what level of risk it's willing to tolerate up to that particular amount of security.
Yes.
And is an advantage of having this sort of accredited franchisor policy that it makes for some ready rules to be able to facilitate lending to what are going to be small businesses.
Yes, it does.
Does Westpac see it as something that is favourable or facilitative to having lending to small businesses?
Yes, it does.
Right. And are there advantages to Westpac in having these types of accredited franchisors?
I think it's a risk-based approach, and it gives the guidance to our banker and also gives guidance to the market of what we might be looking to do. And as you were talking about before, it shows some, on one of those pages there, it shows the results and projections. It also shows the franchising setup cost. So it gives a number of what you'd expect with the cost would be for a low, average and high as well. So it helps with a risk-based assessment. It's a risk-based management approach.
And one of the things I wonder about then is an advantage of this that a potential small business owner might come to the franchisor, and the franchisor would in turn direct that potential small business owner and therefore potential borrower to Westpac for their loan to buy the business?
Yes, there is an advantage to a franchisor of having accredited banks, because then the banks will typically understand what they're doing and what their strategy is, and it will help in a risk-based decision.
But also for Westpac, there's an advantage, isn't it? It sets up some potential of referrals coming from the franchisor to the bank?
Not necessarily. But they will publish and say that Westpac is accredited or Bank X is accredited. So they will use that. Yes, they will use that information to share it with potential franchisees.
Do you know whether Pieface was accredited with any other bank?
No, I don't.
Okay.
No.
Did you listen to Ms. Messiah's evidence yesterday?
I listened to the majority, but not all of it. A few dropped out a little bit.
All right. She gave some evidence, which was that when she'd spoken to the franchisor had suggested to her that it would be necessary for her to move all of her borrowings over to Westpac. Did you hear that?
I did hear that.
And do you have a view about, perhaps break it down first, would that have been correct?
No.
I suppose I should qualify, other than that, if, for example, it was necessary that there be security over her house and there was already a first mortgage over her house, then with another institution, then it may have been an issue for Westpac if it was only the second mortgagee, I assume. But other than perhaps some issue around that, it's not a requirement.
There's no requirement.
And does it surprise you then that the franchisor would be saying something like that to the franchisee or potential franchisee?
Yes, it does surprise me.
Perhaps one possibility here is there's just some misunderstanding of what it is that the franchisor was saying to the franchisee. You just can't comment on that.
Hard to speculate. Very hard. I wasn't there.
And then can we go back to the page .0334?
Mm-hmm.
Sorry, .0333. Now, I'll just leave that there for a moment and we'll come to it shortly. You know that Ms. Messiah applied for finance and was ultimately granted finance?
The company,
Yes, the company Marjo.
Yes, Marjo did, yes.
And before we come to the detail of that, is that something that you reviewed or you've reviewed the documents for to form a view about whether or not the loan should have been made?
Yes, I have.
And have you formed a view about whether the loan should have been made?
Yes,
And what is your view, Mr. Welsh?
the loan should have been made.
Should have been made?
Yes.
Okay. And do you want to just explain to us, you're aware obviously of the FOS decision, FOS determination,
Yes, I am aware of that.
and I take it from what you say then you disagree with the FOS determination?
I disagree with the way the FOS made the determination, but I do agree that we are bound by the FOS determination and we have met that determination. But I disagree in two main ways with the FOS determination.
Of course, and so to be fair to you, of course Westpac has complied with the FOS determination. It was binding on Westpac.
It is, we are bound by them, yes.
And you've
Yes.
complied with it.
Yes.
And all you're raising here then to assist the Commissioner are the two ways in which you disagree with the reasoning of FOS.
That is correct.
And do you want to, perhaps if we take them one at a time, do you want to explain the first way in which you disagree with the
Yes.
reasoning?
So, Commissioner, in assessing the serviceability, one of the normal practices is to provide what we call a buffer on the interest rate. So that's a higher level of interest rate for the serviceability. The implication of that is it makes takes it through the cycle. It makes it obviously a little bit more conservative in our approach. FOS's determination was that they used a 50%, another 50% on top of the interest rate, and I think that is, my personal view is that is very high. They used a 3% buffer for a business loan.
Yeah, so the buffer that had been used by Westpac was 1.5%?
Westpac's policy is to either take the higher off, the actual interest rate, or at that point in time, what we call the BSR, which was the 6.5. So it was the higher off.
Right.
So the more conservative approach.
But I thought when you were saying they took a 50%, it was 50% higher, that was because the buffer that was used by FOS was 3% and the buffer that had been used by Westpac was 1.5%.
Sorry, let me clarify. FOS used a 3% buffer
Yes.
above the loan.
Yes.
Yes.
And you said
Yep.
a 50% higher, or did you mean 50% higher than the interest rate?
Sorry, bundling numbers here. For clarity, it is, let's call it 6%. They added another 3%.
Yes.
So my 50% in my statement was 3 on 6.
Yes, all right.
Thank you.
I understand. And your point is the buffer that you would have added or that you'd have considered appropriate would be what's 1.5% on top?
Well, but I think the rate was 5 point something at the time, and we took the higher of 6.5.
Okay.
3% buffer, in our view, would prohibit a lot of business lending,
All right.
and that will be very concerning for me.
All right. And are you able to explain to the Commissioner two things? The first is, when Westpac goes about figuring out what buffer should it allow, what's the process that it goes through to figure that out? There must be some judgment involved in that.
I don't know the technicalities of it. Apologies, not my area of expertise. There's some smart mathematicians that work that out.
All right. And when FOS went about coming up with its 3%, could you understand what the rationale was for picking 3%?
No.
Okay. And so the judgment that you're making is to say, in your experience as a banker, to start using a buffer which equates to 50% of the interest rate is likely to have a significantly detrimental effect on the ability of the bank to lend to small businesses.
That's one argument.
Yes.
There's also another.
And what's the other argument?
The other argument is small businesses are, when they're gearing up, it's a pretty challenging environment for businesses out there. And if they're gearing up and the banks are adding another 3% on their ability to back themselves and get a loan, that would mean a lot of businesses would struggle to get finance at that 50% buffer mark. So I think it would limit a lot of the businesses in that growth phase.
And was there another, have you covered the two areas?
No.
There's a second area that you want
There's more.
So there's more. So could you perhaps then tell the Commissioner what's the second way in which you disagree with the FOS determination?
It was to do with the amortisation. So, Commissioner, typically the approach is you obviously have to have interest and the amortisation over the term of the loan. FOS deemed that it was appropriate to amortise a overdraft, and we describe an overdraft as a come-and-go working capital facility. So in a normal operating business through a normal cycle, that should go up when that needs to, and then be paid down as the funds come in and out. So when you're looking at the establishment of a business, you want to make sure the overdraft is intended to be come and go. So that was the first part of it. The second part of it is FOS also determined that the banker undertaking, and effectively it was a guarantee for the rent, they amortise that. Our approach is to take the fee for the fee for the 6-month fee as the charge there, not amortise a contingent liability. So they were the two fundamental views that we took.
And what I'd like to do now is...
Can I just understand what time horizon is relevant to those inquiries? You are saying, look, we've got to cope with the fact that interest rates may move. We've got to look at questions of, should I take account of amortising the overdraft to zero?
Yep.
What's the relevant time horizon
Thank you.
that should be in mind in your view when you're making these assessments?
Well, in my view, I don't think you should be amortising the overdraft or the guarantee, the contingent liability. So there is no time horizon. I don't think you should. So that's that one. The time horizon for looking at your BSR, as we call it, but that is a rate that we will assess. You know, the facts are that I don't think interest rates have gone above that rate over the period. We're in a low growth, low interest rate environment, and to sort of so that it hasn't moved. You would want to move it as the market moved and look at it dynamically. Yet it's not something you're moving all the time, particularly in this low growth interest rate environment.
Yes.
Are there any more questions you had about that,
Go on.
Commissioner? Thank you. Mr. Welsh, what I'd like to do now is you might keep that document on the screen and move it to one side, and I'd like to have a look at the credit assessment memo for this particular application. Can we bring up what is tab 38 to Mr. Welsh's statement? It's WBC.404.001.1016. And if we go to page .1018, this is the dynamic deal build request form output.
Yes.
We've looked at one of these already. I want to go first to page .1023. And can we blow up the section called transaction risk? And you see, to explain, the transaction risk is medium. I should probably ask you to begin with, are there different grades of transaction risk that would be used for these types of deals?
There's different grades, yes.
And what does medium indicate?
From memory, 100% LVR was at the medium.
Okay.
Yes.
And it explains the transaction makes sense to the bank. The facilities requested will be fully secured by residential properties. LBB recommend, I'm sorry, what's LBB? Is that local business banker?
Yes, it is.
Local business banker recommending to take out fixed and floating charge over the business, as we are relying on business income when serviceability was calculated. And then the transaction makes sense to the customer. This will be an opportunity for them to manage and own their business with a possibility of acquiring more pie-face business in the future.
Yes.
And in that sense, is it fair to say one of the things that you would probably point to looking through this is there's a consideration not just of something that's in the interests of the bank, but also of understanding what the desires and goals are of this small business or these small business people.
That is correct.
And then if we go over to page .1024, and blow up the section serviceability / end clearance risk. So this explains that the local business banker calculated 2 serviceability scenarios, and it's based on profit and loss provided, but it explains, please note that there is no current financial available, business is only 8 months old. And can I ask what, from your review and looking at the documents, what's your view as to the appropriateness of making a loan in circumstances where the business has been going for 8 months, but apparently there's no current financial available?
What is my, can just the question?
What is your view as to the appropriateness or the significance of that in making the loan?
I think it's a factual statement, so if that was, that's factual statement, so you have to rely on that if it had only been going for 8 months. As we will uncover further, that was not correct. The business had been running for a 6-month period and then another 9-month period, and there's further dialogue in the file on that.
Setting though aside the detail of that, I just want to just take the hypothetical of it, which is the business has only been going for 8 months. There's no current financial available. Is that something that is significant or insignificant in the context of making the lending decision?
I think it's an important part of making a lending decision if you've only got 8 months financials and you've got them. You want to review them and be very clear on them.
And then if we go to page 1026, and you see at the bottom of the page, there's something which is, or it's under a section called sector policies.
Yes.
And does this, it says that the sector policy is franchise. Does that connect to that, back to the franchise data that we're looking at on the left-hand side of the screen for Pieface, or is that something different?
My assumption is it does connect.
Okay. And we see that it said sales as per projected cash flow, $525,000, which is below benchmark.
Yes.
And then gross profit, I'm not sure why that's redacted. It's not subject to a non-publication direction, but it's, the gross profit is 63%.
Yes.
And it's noted there that that's 1% more than benchmark. If we can just pull that down again so that we can actually see the benchmark. So the benchmark at the low, average and high scenarios is 62%. So this is just pointing out it seems to be 1% higher than that benchmark.
Yes.
And then at the bottom of the page, average weekly sales of $10,750. It says, which reflects to the above, but not within the benchmark. And we can see over on the left-hand side, looking at the detailed financial information that Westpac had available about Pieface franchises, that the low average weekly sales is $13,000, and the average is $17,000, and the high is $21,000. Is that something that, so that difference then between the average weekly sales being shown and what Westpac knew or had available to it from its benchmarking, is that something that you would expect to have been of concern?
It should be noted, and it was.
And I just want to chase that through. How far does that go, though, from your perspective? If you're being a responsible banker, what are you supposed to do with that information?
Well, what the banker did note here was that not within the benchmark. However, as mentioned before, this is due to the store being a small store, and all figures reflect on each factor. So they were recognising in the submission that this was a kiosk type store, and I've read that somewhere else. Apologies, I can't recall where. So it was and I'm not sure why, but I think the deal has slightly changed a little bit. It was at the smaller end of their stores because it was kiosk.
and we just turn over the page to 1027. This might be the part you're referring to at the top of the page.
Oh, thank you.
This is a small store in the shopping centre. Kindly note that the store is a kiosk-style store. Were there many, although having said that, were there many pie faces that weren't kiosk-style stores?
I'm not going to be able to help you there, sorry.
I take it you never ate at Pie Face, Mr. Welsh. Turns out not enough people did. What I want to just understand, though, is when you look at this transaction assessment, the way that it's put is that the assessment is lower than sector policy benchmark for Pie Face, and then it said, well, that's explained by the fact that the store is a kiosk-style store, and it said our customer is purchasing the Pie Face, however, this will be fully secured by their residential homes. And does that suggest that the comfort for the bank in this is that the residential homes are available as security, and so that makes the bank more relaxed about the fact that the performance is not in line with the franchise benchmarks?
I'd use slightly different words, but what it signalled to the banker is you start to look for other mitigations. So my read of what the banker was saying here, the other mitigations is that you have other incomes and other security. So you've moved away from just looking at this transaction and you look at the broader what's involved in the transaction. And that's quite a normal part. You expect risks come up and then you expect the banker to mitigate them and look more broadly around what the mitigants might be.
Right. And I take it, apart from the things that were concluded by FOS, looking back through these documents, there's nothing in it from your perspective that suggests that there was something inappropriate on the part of the banker in accepting the information that was provided and the way that information was assessed and then ultimately in the making of the loan.
Broadly, I'm happy with it. There's a few things that I've read that I would have liked to have seen more information. There's a few gaps there that I would have liked to have seen filled and a bit more explanation around. And you can see that later in the file where there's a bit of a to and froing from the credit officer on a number of options and questions coming back. So there was obviously lots of discussions going on as the deal got built up and bits of information was flowing around. But there's still a few gaps there though.
Right. And we can go to these documents if you wish. I assume you've looked at them or they've been provided to you. You know that Westpac hadn't conducted a review of the Pie Face franchise system in 2012.
Had not
conducted a review in 2012.
Correct.
And in 2013, I'm assuming you've seen there's some internal notes or emails where it's noted that no review had been done in the preceding year.
Yes.
And at that time, Westpac decided that it would suspend the accreditation of Pie Face.
That is correct.
And in suspending the accreditation of Pie Face in 2013, Westpac was concerned about two aspects, I think. One was the risk of lending it had made to Pie Face, the franchisor, is that right? Or is it only concerned about the second aspect, which is that it's whether it should lend to additional franchisees, having regard to its concerns about Pie Face?
There were two bits. There was the any lending to the franchisor that was parked and kept separately. Then it was typically when you are looking at a portfolio like this, you're looking at future whether you're going to be accrediting future franchisees. So at that point we determined to remove the accreditation.
And the concern is, as to the second part, that having regards to your concerns about the system at that time, that it's no longer safe, I think might be one way of putting it, to be lending in accordance with the policy to franchisees.
Well, the specifics on this one was that they had a tax liability, and tax liabilities are a signal that all might not be going as well, and they'd had a number of calls on some guarantees, and that's when you're getting those, it's a trigger that's something up, and we made the call until we could remediate that position or got more comfortable with it, that we wouldn't allow any further lending to franchisees under the sector policy.
All right. And I think perhaps just so that we can nail this down to a time period, can we bring up WBC.404.014.0582?
Give me a hint on the tab.
Oh, that's not in your
Okay.
folder.
Don't know that number.
And I think this might have been one of the types of documents you're referring to. You've had a look at these chain of emails before you've given evidence, I assume?
Yes, I have.
Okay. And so what happens is that we don't necessarily need to do the earliest email in time, but if we take the email at the bottom of the page on the 26th of July 2013, it said franchisor has gone
Can I just go down to it? So I can
Oh, yes, sorry.
Thanks.
Franchisor has gone E35 due to tax arrangements. Franchisor facilities are fully cash secured. What does E35 mean?
E35 is a risk grade that we use for our watch list clients.
And it's then explained that while there may be reasons around this, I consider the situation completely unacceptable for a franchise intangible lend.
Yes.
And then the response is, I agree, there are enough warning signs here which effectively mean we have little choice but to remove accreditation.
Yes.
Attend to that document, Commissioner.
Exhibit 3.23, emails between Skewins, Jackie A and others, 26 July 13, WBC 404.014.0582.
And then if we go to .0003, I'm sorry, WBC.416.004.0003, so this is another chain of emails, but I just want to deal with the email on the 30th of July, which is at the top of the page, which is the next day. And you'll see again that what this is confirming is that it would be prudent at this point to suspend Pieface accreditation until a review is completed to the satisfaction of credit policy. It sets out various warning signs, including, by this stage, franchisee legal action, and then says, if we as a bank are not prepared to lend to the franchisor, it does not seem wise to lend to the franchisees on an intangible security basis. And that reflects the decision that was made and I think recorded in you explained in your statement by Westpac to suspend the accreditation.
That's correct.
And the point of this is, at this point in time, by suspending the accreditation, what's happening is that the bank is no longer lending on what's described here as the intangible security basis. It's no longer just sticking to that sector value ratio approach.
A banker is no longer to utilise that policy for new business.
But that policy in any event was not used for the loan to Marjo.
That is correct.
And
Is that email chain going in?
oh yes, I attend to that, Commissioner.
Exhibit 3.24, email Jackie A, Watt and others, 30 July 13, WBC 416.004.003.
Commissioner, is that a convenient time? I won't be that much longer with Mr. Welsh, but perhaps if we just bring him back at
2 p.m.
2 p.m. Thank you, Commissioner.
Yes, Mr Hodge.
Thank you, Commissioner. Mr Welsh, I just wanted to go back to something you were explaining before the break or before lunch about that annual versus 3 yearly review. Can we bring up tab 4 to your statement, which is WBC.409.004.0206? This is the franchise system accreditation standards.
Yes.
And you explain in paragraph 53 of your statement that reviews were governed by this standard.
Yes.
And I thought before the break you were referring to short form versus long form reviews.
Yes.
And under the franchise system profile, at the bottom of the page, you see there's a reference to annual reviews, long form, and then a further reference to franchise system annual review, and it explains that you're to do an annual review if it doesn't meet the requirements for a short form annual review. And is that the point that you were making before lunch, or were you suggesting something slightly different as to your understanding of how the policy...
That's the point I was making.
Yes, that if you satisfied if a franchisor satisfied the criteria, there'd just be a short form review done annually. Yes. Is that right?
Yes.
So there'd always be a review, but it would be either short form or long form.
No, that's...
If you go perhaps to page 0209. You'll see there's the two types, short form annual review and long form annual review. Is that's slightly different from your understanding, I take it?
It is.
You had thought it was only necessary to do, at the time, that is back in 2011, 2013, you only needed to do a review every 3 years.
Under the franchise system can only qualify for short-time reviews 2 years and every 3 years each system must be reviewed in the long form.
Yes.
Yeah, that's the...
So each year there's to be either a short form annual review or a long form annual review.
let me just... Sorry, can you just give me a moment to clarify that?
Sure.
So my understanding of this is, you can see on the page you drew me to, 0209, and you see that on the last dot point in that first box, every 3 years is the long form review. That's where it's from there. So am I following you correctly? So,
I think we're in disagreement. What that box says is franchise systems can only qualify for short form reviews 2 years in succession.
Yes.
Every third year, each system must be reviewed in long form.
Yes, in the long form.
So there must be a long form every 3 years.
Yes.
And each year, there's to be an annual review. Do you agree with that?
The practice that we adopt, if there was a material change, if there was a change, that's what I thought occurred there. I might have...
And again, just to clarify, the short form annual review, when you look at the requirements of it, it's pretty limited. It would only require updating the franchise system profile document with current details provided by the system, if provided necessary. And within the general comments section of this document, the FDM is to provide an undertaking and confirm that no adverse features are known.
Yes. That did not occur.
That didn't occur. Yeah. And so let's just break that down. The first thing is there was no undertaking given by the FDM, who is the franchise or development manager?
Franchise development manager.
Franchise development manager. The franchise development manager didn't give an undertaking in 2012 that no adverse features were known?
That's correct.
I
haven't seen-
in
sorry.
respect of pie face.
Yeah, I haven't seen one, so I don't know whether they did or they didn't, but we weren't able to find one. That I wasn't able to cite one.
And under this policy, in the absence of that undertaking, a long form annual review was to occur.
Yes.
And the long form annual review should have occurred for pie face in 2012, but it didn't.
I'm getting a little confused, please.
Yes. Let me break it down. Phrase I think I'm using quite a lot. Not just with you, the franchise development manager had to provide an undertaking that no adverse features were known. That's one of the requirements.
Yes, correct.
And if you look up the page under qualifications for short form annual review, one of the qualifications was the provision of that undertaking.
Yes.
If you didn't qualify, if a franchise system didn't qualify for short form annual review, then the franchise had to be reviewed under the long form annual review.
If it didn't qualify, meet those hurdles.
Yes. Pie face in 2012 didn't qualify under the qualifications for short form annual review.
I don't know.
Well, it could only qualify if there was an undertaking that had been given,
But I haven't seen an undertaking.
and no
I
one
couldn't
could find an undertaking.
Correct.
And therefore, it would appear as if what was necessary was a long form annual review.
If a short form wasn't done, but 2012 we weren't able to find one.
And had a long form annual review been done, then it would have been necessary, it would have been required that necessary documents and financial information be obtained from the franchise system
A long one, yes.
under the long form. That's
Yes.
right. All right. And then can we bring up WBC.409.003.0240? So this is the deal header in respect of pie face. That's the franchisor, is that right? Or
Yes.
the franchise system.
Yes, it is.
And if we go over to page .0241, and type's quite small. If we just
If you could use that blow up technique, that'd
yes,
be
if we
useful.
blow up the section in the first box dated the 9th of February 2012, if we blow up the paragraph at the end of that box beginning CRAA indicates, so who's the CRAA?
Don't know. Sorry.
Okay. What does it stand for? Or you're not sure?
Not sure.
Credit
Credit
risk assessment something?
Might be.
And
Not so good on 2011 acronyms.
And it explains there's been a default that's been loaded in respect of pie face, and then concludes by saying we will also require financial statements to ascertain trading position and reassess CRG.
Yes, that's correct.
And then if we
Yes.
take that down and blow up under the section 28 February 2012, and blow up the section under housekeeping issues, in the middle of the page. So this is as at February 2012, upon receipt of latest financials deal to be submitted and background/business risk section in sponsor memo updated with relevant information to fully understand how the business operates, including details, locations of retail stores, directors' shareholdings details.
And remind me of that date, please.
That's the 28th of February 2012.
Thank you.
And then if we come down to the 27th of March 2012, and then we blow up the section, if we just note there's a phrase which is default against Pieface was dealt with via TLW deal number 1013555049. Do you know what that means?
Yes, I do.
And what does that mean?
That's reference to another credit memo like this. So this is the banker's credit memo, the banker of the Pieface franchisor.
Right.
So this is the banker's notes. This is the banker's TLA record of that, which is the lending origination system, the lending system.
And it means what had been a default against Pieface had been dealt with by a TLW deal. What does TLW deal mean?
That's a previous one of it. So what we're working through here is the previous background of the decisions.
Mm-hmm.
So there'll be another submission like this that will have where they would have worked that through. So if you track down that deal number, there'd be another submission that would cover that.
But that deal number is the very first one on the 9th of February 2012.
It's hard to follow, but
That's right. And then as at the 18th of October 2012, if we blow up the last 4 lines at the bottom of the page, you'll see it said pending current financials being reviewed.
Mm-hmm.
So it appears, as at the 18th of October 2012, the financials hadn't yet been, the review of them hadn't been completed.
For this submission, at that time,
Yes.
yes.
And have you seen any record of the receipt of all of Pieface's financial statements in 2000, or financial statements from Pieface in 2012 by Westpac to ascertain, effectively to carry out an annual review during that year?
No, I haven't looked into the franchisor records.
Okay.
Apologies, I didn't think that was part of.
No, that's all
what was
right.
part.
And then by the beginning of 2013, if we go over the page to .0242, and by the 27th of February 2013, if we pop out the first line underneath that, beginning deal declined. See, deal declined by DE. What's DE stand for, do you know?
Don't know.
Deal declined by DE due to connection, and the connection is Pieface. Is that right?
Correct.
Pieface not being in good standing, 1 default and 2 judgments listed against the company
Yep.
in CRAA.
Yep.
And then,
The view may be that that's Credit Reference Agency Australia.
thank you, Commissioner.
Let's suspect that.
You agree? You think that's what it means?
I think so, but I don't know.
He's much better than us.
Yeah, no.
Real get
I am, but I'm being a little more
I would
careful
say
on,
that,
on what I call on this now.
That gets you nowhere, Mr. Hart.
That's not been my experience, Commissioner. And then subsequently, as we know, we come then 4 months later to when the suspension occurs from Pieface. Now, what I'm interested in is, from the bank's perspective, is its reflection that not having conducted an annual review in 2012 was a failure on its part, something it ought to have done?
No, I don't think Sorry, an annual review of, a short form review of the financials.
Well, I didn't.
A
Well,
short form review of the franchising operating system you're asking about?
I know. At the moment, I'm asking about a long form. I think I should be more specific.
Okay.
Does the bank regard it as a failure or oversight not to have conducted a long form annual review?
I think
in
we're muddling a
2012?
few things here. Maybe if I can just clarify something of my understanding on this. This here is the record of lending to the franchise system. So this is our banker writing their normal deal, and so those references there for overdue accounts are quite normal as you're getting their accounts to make an assessment of the guarantees and the facilities that we find. So that's an independent assessment of the franchisor, as it just so happens that we were the banker to them. So that's at one end, and needs to be split quite differently from what the franchise development manager would do. What the franchise development manager should do is do a short form report, and I was not able to find that short form report, so I don't know whether one was done or not done.
I understand and let me put it back to you and to see if I've correctly understood it. You're saying you have to draw a distinction between, on the one hand, the lending by the bank to the franchisor,
Yep.
and on the other hand, the lending by the bank to the franchisees of the franchisor.
Yes,
That's the first part. And the second part is this document that we're looking at, which is identifying problems dating back to the beginning of 2012. That's problems in relation to lending to the franchisor.
Yes.
And there's a separate process or a separate person who ought to be responsible for managing the franchise system and lending to the franchisees.
Yes.
And under the policy, that person doesn't appear to have given the necessary undertaking so that only a short form annual review is required. You haven't been able to find it.
I haven't been able to find it.
But in any event, it's not evident that any long form annual review was carried out in 2012.
Correct.
And the fact that no long form annual review was carried out in 2012, to return to my question from a few minutes ago, is that something that Westpac regards as a failure on its part?
Well, if the short form review didn't occur, it would be yes.
Right. And beyond that, is it fair to say what the consequence of that might or might not have been for any franchisees that Westpac was prepared to lend money to in 2012 and the first half of 2013 is, from Westpac's perspective, just a matter of pure speculation?
So can you
Let me put it another way. We have no idea what it is that would have happened if Westpac had performed a long form annual review of the Pieface franchise in 2012.
Correct.
We just don't know.
You don't know.
And whether it would have resulted in the action from mid-2013 being brought forward a year earlier and suspending accreditation, we just don't know.
That's correct.
And if Marjo had come in August of 2013 to Westpac rather than in 2012 and sought money to buy an existing Pieface franchise. So take that as the hypothetical. Having regard to the suspension of the franchise system, would there have been a different outcome as to whether the money was loaned out to Marjo?
Hypothetically, yes, and if they were borrowing under the franchise policy.
Well, of course, they weren't borrowing under the franchise policy. But when it came to the assessment of whether to make this loan or not, would it have made any difference at all?
Well, I think the benchmark still would have stayed the benchmarks would have been relative. So it may have made a difference, but it's hard to speculate.
Yes. It was the point that when it came to the income, when you were dealing with it in 2012, you had the benchmarks, but they weren't being assessed under that franchise policy that required assessment with respect to the benchmarks? That's the first point.
Well, we don't know that because we couldn't find the short form.
No, I'm sorry, I've confused things. In 2012, when Marjo
Yep,
applied for money, it wasn't assessed under the franchise policy.
you got me back. Yep. I'm on that.
And yes, there were benchmarks within the franchise policy that it's obvious that credit people within Westpac took into account in looking at Marjo's facility, but they weren't determinative in deciding whether to make the loan to Marjo.
I think the benchmarks would have been looked at, and one of the things that was factored in, you use a number of different things to pull information, historical accounts, forecasts, the benchmarks. So you're trying to put together the puzzle.
All right. And well, the way in which ultimately the cash flow was tested was by evaluating cash flow and serviceability in two different ways for Marjo.
Yes.
And are you able to, I can take you to the FOS determination if that would help, maybe just as a reference point. If we go to WBC.404.012.0507, which should be tab 58 of your document. If we go to page .0518, and blow up the part at the bottom of the page which is cash flow projections relied upon by the FSP showed there was net cash available for debt servicing.
So you're just going to, there we go, thank you.
So there's this reference to the two different cash flow projections.
Yes.
Are you able to just explain to the Commissioner what's the process that's involved here for coming up with these two cash flow projections by Westpac?
So these are the two cash flows that the company provided through their accountant. So they're in one of the previous tabs, they're the cash flow, and that's the top line revenue of 300,000 as a base case, and the second one, cash flow 2, is the other alternative. They provided two cash flows through their accountant.
And these were the two that were provided by the applicant to Westpac and then used by Westpac in order to decide whether or not to make the loan?
Along with a number of other things, yes.
And one of the things that Westpac did was to do attempt to do some sort of stress test of these. I'm using the word stress test. I'm not sure that's Westpac's word, but that's what was
a number of different scenarios. They looked at a number of different scenarios and tested those assumptions. And the credit, you see that these were the two that the banker did and the credit officer did a number of them.
Yes, if we go to to tab 38, which is WBC.404.001.1018. And go to page 1024. This is something we looked at before under the heading serviceability and clearance risk. Can we just blow that up? And this, as I understand it, are the scenarios done by the banker rather than by the credit officer, is that right?
That's correct.
All right. And the banker's second scenario seems to be that ICR, which is that interest cover ratio?
Yes, it is.
Interest cover ratio is below requirements. Loan requested will be fully secured by residential properties. And I think that might, I just want to be clear about this, that might be the way in which the banker has framed it. But from Westpac's perspective, there are two different serviceability scenarios that have been done by the banker.
Yes.
That's the first point. And the second point is there are other ways. This hasn't just been left by, just automatically accepted by the credit officer. The credit officer has also looked at this as well.
Correct.
And the fact, therefore, that the effective level of the lending is effectively 125% of the purchase price of the business or something in that, or perhaps 110% of the purchase price of the business, because $330,000 plus a further $32,500 for various things. Mm-hmm. That's not lending that is simply derived from the fact that there is an asset. That's the first point. It's not from a residential asset.
Sorry, I don't understand the question.
I'm sorry, I've put that very badly. When you read this note, what I'm trying to get you to confirm is perhaps what's obvious, but we ought to make clear, and that is, this isn't something where somebody is prepared to do this just because there are residential properties available as security.
That is correct.
There are a lot of other things that are taken into account in trying to assess the serviceability by Westpac.
Yes.
And it's certainly not the case that Westpac was comfortable just lending money without being satisfied on various scenarios that it was possible to service this loan.
Yes.
And as it turned out, this loan failed, or the business failed, and the loan couldn't have been repaid.
Yes.
But as we heard yesterday, there were many factors that went into the failure of that business.
Yes.
And that's certainly the view that Westpac takes, that it was prepared to back a business to lend money. And as it turns out, it's unfortunate that it failed, but as you've said, you don't think that there was anything wrong with the way in which you went about doing it.
That's correct.
Now, the other thing that I wanted to ask you about then is the collections notices. Is this something you do accept Westpac got wrong? The sending of the collection notices?
Yes, I do.
All right. And if I can just summarise a few elements of this. Ms Messiah made a complaint to FOS, and the consequence under the terms of reference is that the FSP, that's Westpac, ought to have stopped sending the collection notices.
Yes.
After the complaint had been made, Westpac's records are of 13 text messages being sent between the 17th of November 2016 and the 3rd of December 2016.
Yes.
And I'll just get up the document that you've exhibited. So I just want to ask you a couple of questions about this. It's tab 68. If we go to wbc.404.012.4242. So this is the internal record that Westpac has kept, is that right?
This is one of the records.
All right.
This is the one that tracks the texts.
All right. And are you able to actually just explain to us what it means? What's the SMD ES2, and then once we get over the page, DST?
No, I'm not able to explain the detail.
Somebody's told you that it means that 17 text messages were sent.
13, I think it was, wasn't it? Or was it
I'm sorry, 13 text messages over the course of...
No, we did. This isn't a great format of that, but yes, there were 13. Sadly, there were 13 text messages that shouldn't have been sent.
Yes.
Yeah, and they shouldn't have been sent to Mr. Messiah.
And there's two things I want to ask you about. Now, one is, this is obviously a breach of the terms of reference of FOS that Westpac has signed up for, and that's a problem.
Yes, that's correct.
Would it be a problem to send this many text messages to a customer trying to collect a debt if they hadn't made a complaint to FOS?
Making a complaint to FOS the determination for us. This shouldn't have happened.
I see. So the problem is not simply the fact that it was a complaint while the FOS, it was sent while the FOS complaint was on foot. The complaint was also sending this many automated collection notices.
Yes.
All right. And do you know whether there's been investigation as to why it is that Westpac Systems did this?
I don't know whether there was an investigation, but I asked that question and there was an explanation.
And what was the explanation?
The explanation was that we had been working with Marjo and the related parties, and we tended to be focusing on the business. This was Miss Messiah's own home loan, and that was not connected to the business, an error by us. So that's where we made an error by not having to manually load up the do not contact code for her home loan. We had it on the business and those sorts of things, but not on her home loan. We made that error.
Yes, I'm not sure that quite addresses the issue. So you're pointing out that she made a complaint to FOS and the complaint included her home loan, and therefore the do not contact flag should have been put up with respect to the home loan, but it wasn't. Is that right?
That is, yes.
And the manual error is failing to load the do not contact flag in light of the FOS complaint.
Yes.
But that means what otherwise happened was just the usual automated consequence that would happen without a FOS complaint.
I didn't investigate that, sorry, I didn't look at that.
And
So
do
I
you
don't
know whether anybody has investigated why it is that this would occur absent a FOS complaint?
I wasn't an area I explored here.
But certainly from your perspective, that's unacceptable behaviour by Westpac to be sending debt collection text messages to a customer, in fact, 13 times in the space of 17 days.
It's not an area of my expertise, the collection side, but yes, that seemed a lot to me.
Thank you, Commissioner. I don't have any further questions.
Thank you. Yes, Ms. Colston.
Two matters, please, Commissioner. First of all, Mr Welsh, you were just asked some questions a moment ago about the FOS determination and the reference in the FOS determination to 2 cash flows. Would you like me to bring that up again so that you can have a look at that?
Yes, please.
Oh, just one moment. It's tab 58 in your folder, Mr.
Which one?
It's tab 58 in your
58,
folder.
thank you.
It's WBC 404-012-0507. And it's at page 0518.
Thank you.
There's reference here to 2 cash flows. I think you said they were cash flows provided by the Marjo accountant.
Yes.
And could you now go to the other folder, tab 34? This is document WBC 404-001-0302.
Yes.
Is it your understanding that if the operator could just scroll through that document, and Mr Welsh, you've seen this document before?
Yes.
Is it your understanding that this is the cash flow referred to in the FOS determination?
Yes.
And did you satisfy yourself from your review of the file that that was the cash flow projections provided by the Marjo accountant?
Yes, I did.
Secondly, you were asked some questions a short while ago about an annual review of the Pie Face franchisor in 2012.
Yes.
and whether or not there was a long form or short form review conducted.
Yes.
If the operator could please call up WBC 409 002 0418.
Okay.
You see that's a franchise system profile for Pieface in August 2012. Do you recall when the Marjo loan was applied for and granted?
Around that period.
Or was it shortly before?
Yes.
And if the operator could go to the next page, please. And to the page after that, please. I don't mean to rush you through this, but perhaps just to assist with timing, I might just direct you to the next page, 0421, just so that you get an idea of what's in this document. If the operator could move to 0425. You see this, you're shown a document with a similar profile, but it was a different document. You see
Yes.
this document also has the benchmark results in categories low, average and high.
Yes.
And you will see the reference to the last review and this review, and you note that the date for this review is the 30th of the 8th, 2012.
Yes.
And if we could go over to 0427. Mr. Welsh, are you able to say whether this is a short form or a long form review? There are further pages if you need to
This
look
would
at
be
those.
the long form one.
Yes, so do you believe, based on this document, that a long form review was conducted in August 2012?
Yes.
Nothing further, Commissioner.
Is this document in evidence, Ms Cobshan, or not?
Yes, please, I'll attend to that.
Exhibit 3.25 will be franchise system profile of what date, Ms Cobshan?
August 2012.
August 2012, WBC 409 002 0418.
Thank you, Commissioner.
Yes.
Could Mr Welsh be stood down, Commissioner?
Yes, thank you, Mr Welsh. We will see you again, I think, later in the week, will we not? Yes.